We saw gold consolidate for a long time around 2000, fluctuating up and down substantially, really since 2020, before it broke out again. Given the inflationary aspects, there could be big scares. Like I said, you could see substantial retreats, but the inflation is still coming. The money printing is still happening. And by the way, whether there's, peace and rainbows everywhere around the world or not, the central banks are still buying. Even China's back buying gold again. So where I said it's possible we could see a big drawdown, I don't actually expect that. I do think we could see another period of consolidation before another major breakout, though. I have a feeling that we'll probably see higher prices over 2025. If gold becomes the flavor of the day and people just all decide to pile into gold, 3,000 itself could trigger 3,500.
Gold prices have reached a 6-week high, trading at $2,647.80 per ounce, up 0.44%, as markets respond to multiple factors affecting the precious metals valuation. The increase comes as investors closely monitor substantial U.S. debt issuances, particularly the upcoming 10-year and 30-year bond allocations. The People's Bank of China has emerged as a significant driver of gold's momentum, announcing a 10-ton purchase in December. This marks the bank's second consecutive month of gold reserve increases, bringing its total holdings to 73.3 million ounces. Following a 6-month pause last year, the renewed Chinese buying activity signals a strategic return to gold acquisition by one of the world's largest central banks. Lobo Tiggre, editor of The Independent Speculator, presents an optimistic outlook for gold's future performance. According to Tiggre, prices could exceed current expectations if gold gains broader market appeal and becomes a preferred investment vehicle. He suggests that reaching the $3,000 mark could be a psychological catalyst, potentially driving prices toward $3,500 or higher due to increased buying momentum. Market analysts note that while gold prices are stable, several fundamental factors support continued upward momentum through 2025. These include persistent inflationary pressures and sustained central bank purchasing activities, particularly from China. Despite expectations of periodic market retreats, the trend favors higher prices. Market participants remain attentive to developments regarding potential U.S. tariff policies proposed by President-elect Donald Trump, which could further influence gold's price trajectory. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I wouldn't be surprised if what we're seeing here is another sort of shoulder, if you will. I'm not a technical analyst, but we saw gold consolidate, for a long time around 2000, fluctuating up and down substantially, really since 2020, before it broke out again. Given the inflationary aspects, there could be big scares. Like I said, you could see substantial retreats, but the inflation is still coming. The money printing is still happening. And by the way, whether there's peace and rainbows everywhere around the world or not, the central banks are still buying. Even China's back buying gold again. So where I said it's possible we could see a big drawdown, I don't actually expect that. I have a feeling that we'll probably see higher prices over 2025, but not a lot. Let's say it goes to $3,000, David, from here. That's not actually a huge gain. From where we are now on a percentage change basis, what's that?
About 15%.
Something, it's, that would be nice. I'd take it, but it would be less than last year. So yeah, I would not be surprised to see sideways chop, but I would say sideways to up over the next year. Their product is priced in dollars, or it's quoted in dollars, gold, and their costs are in Australian dollars, which is down versus the greenback.
Yeah.
So to my mind, this is not surprising at all. The more, if you'll permit me to go sideways, the more interesting question, you touched on it earlier, but we didn't follow up, is the difference between gold, copper, and silver. Which way is silver going to go? Is it going to act more like copper? And there was a higher correlation between silver and copper last year than there was between silver and gold. That has improved for silver this year, but we'll see. Silver is still an industrial metal. You asked before, David, if it had to do with silver being a byproduct, that it was acting more like copper until recently. And no, I don't think that's it. I think it's simply the industrial demand. There is, manifestly, measurably, visibly, a much increased industrial demand for silver. And so it responds more like copper to market data than gold does. It is still a monetary metal, and so it does still track gold. And I'm very unhappy about the global geopolitical events that we've seen that have reminded us. But as a silver bull, it's important to me to see that silver does still respond with gold when there's a crisis moment. It still acts like a monetary metal. So I'm not saying that silver is not money anymore. I'm just saying that its industrial side has obviously become much more important. And it's frequent that we'll see on a weekly basis, gold will do this, copper will do this, and silver will go right through the middle because it's responding to both of the drivers. On the bright side, the byproduct issue that you brought up means that if we do see more economic weakness globally and the money helicopters don't fly right away, you could see reduced copper output, which would reduce silver supply at the same time that safe haven demand would go up. And that could be pretty exciting for silver prices. We'll see what happens. But at the moment, I think the money helicopters are going to be good for monetary metals as well as industrial metals in due course.
Recent market analysis suggests that gold's persistent strength near all-time nominal highs may indicate future inflationary pressures, rather than simply responding to current consumer price index data. LoboTiggre's perspective emphasizes the traditional role of precious metals as monetary instruments, particularly suited for inflationary environments. The economic landscape supporting this analysis has become increasingly complex, with recent data from the U.S. service sector showing accelerated growth in December. This business activity expansion has pushed price measures to their highest levels since early 2023, adding another dimension to the inflation narrative. In Europe, the disinflation trajectory has encountered significant obstacles, with multiple countries reporting monthly inflation indicators trending upward. This development poses potential challenges for the European Central Bank, which market participants anticipate will implement a 25 basis point rate cut on January 30th. The reversal in disinflation trends could complicate the ECB's monetary policy decisions. According to a prominent investment bank's analysis, while gold's historic rally is expected to continue, the pace may moderate in the coming year. The timeline for reaching the $3,000 per ounce milestone could extend longer than previous projections suggested. However, the sustained demand from central banks remains a fundamental factor supporting long-term price appreciation. Let's get back to the interview.
I did say undeniable recession by the end of this year with 11 days left as we record. That's obviously not going to happen. All the key economic data, especially with PCE out today, there is no data point that can make recession in the U.S. undeniable. It doesn't mean there has been no recession. We have had manufacturing recession. We've had a commodities recession. We've had a recession, a rolling recession on several fronts. But I don't want to try to escape responsibility. I did say undeniable recession by the end of this year. That was wrong. But I do think it's important to say that doesn't mean that everything is fine. And you could argue, okay, well, we've got this strong GDP growth and people are spending, and that fiscal dominance that you're talking about, that could mean soft landing or no landing. That is true. The amount of spend, the amount of capital injections, even with the Fed tightening, if Congress is loosening at the same time and swamping out monetary policy with fiscal policy, that's what Lynn means by this. We will see apparent health. So I don't think there were no consequences to the Fed's tightening. I don't think the economy is as healthy as people say. And it's striking to me that actually, despite the fiscal denominator, despite trillions of dollars in deficit spending, we have still seen a weakening labor market. In my view, this actually substantiates that people like me were right, that there was going to be harm done by the Fed throttling the economy. That's their whole idea of how to control inflation, is to throttle the economy. They did throttle the economy. And okay, where does this leave us as investors? We can argue about whether it's hard, soft, whatever, doesn't matter. What matters is if the reason why we don't have an undeniable recession is fiscal largesse, that's inflationary. And that affects our outlook for where we're investing going into 2025. And if anything, the fact that gold is held so close to all-time nominal highs backs up my view that this is inflationary. Gold, as you and I have talked, the Big Mac index and all that, gold doesn't correlate with CPI, it leads it. So for gold to be remaining so high, I think tells us that we're looking at more inflation ahead. And I think, and again, not to beat up on Trump, I'm all in favor of cutting government waste and regulation, but his agenda is inflationary. And so as an investor, step aside from the politics, sure, I'm looking at an inflationary environment. Obviously this is good for monetary metals, but I also think after things shake out here and we pull through whatever weakness is left in the economy, it's good for commodities as a whole, and particularly any commodities, minerals, my specialty, that are looking at supply constraints. And the number one on that list for me is copper. Actually, my highest conviction trade for 2025, David, is neither gold nor silver, or even uranium, much as I still like that. It is copper.
Gold's resilience near record highs underscores its enduring appeal as both a hedge against inflation and a strategic monetary asset. With central banks intensifying their acquisitions and geopolitical shifts influencing market sentiment, the metal's trajectory remains compelling. While fluctuating bond yields and tariff uncertainties may temper short-term movements, the broader macroeconomic environment creates favorable conditions for gold's sustained growth. This evolving narrative highlights its dual role as a traditional haven and a modern financial instrument. How do you foresee global monetary policies and geopolitical shifts shaping gold demand and pricing dynamics in the years ahead? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.